Hello traders, welcome to this Blueberry Academy video advanced part 3. In this video we're going to discuss intermarket correlations and using equities to trade FX. Let's start with using equities to trade FX. It's essentially to note that equities and Forex are two different markets, each with its own dynamics and drivers. However, they're often interconnected, meaning that developments in one market can influence the other. Here's how traders might use equities to trade Forex. This involves analysing multiple asset classes to decipher the strength or weakness in one market that might foretell a change or continuation of trends in another market. For example, a strong performance in a nation's stock market can indicate economic health and potentially lead to appreciation of its currency. There's a concept in finance called risk-on and risk-off sentiment. In risk-on environments, traders are more willing to take on risk, buying equities and high-yield currencies. Conversely, during risk-off sentiment, traders flock to safe haven assets like gold, the Japanese yen or the Swiss franc. Recognizing these shifts can provide Forex trading opportunities. If a country's stock market is attracting significant foreign investment due to, say, better returns or stable economic conditions, there would be demand for that country's currency. This is because foreign investors would need to convert their currency to buy stocks in that market. Observing these equity inflows can signal potential Forex moves. For countries heavily dependent on exporting commodities, there's often a correlation between the nation's stock market, the commodity price, and its currency. That brings me on to intermarket correlations. Intermarket correlations refer to the relationships between different financial markets and how they influence each other. In the Forex market, which concerns itself primarily with currency trading, understanding these correlations is essential because currencies don't move in isolation. Instead, their movements often reflect changes in other global markets, like the commodities, equities, and bonds markets. Canada is one of the world's largest oil producers. As such, when oil prices rise, it often benefits the Canadian economy and strengthens the CAD, and vice versa. Australia is a major gold producer. When gold prices rise, the Oz often benefits. Gold is usually priced in dollars. Traditionally, when the dollar is weak, gold becomes a more attractive asset, leading to an inverse relationship between the two. When global equity markets are booming in a risk-on environment, investors tend to favour high-yielding, riskier currencies like the Australian dollar, the New Zealand dollar, or emerging market currencies. Conversely, in risk-off environments, they prefer safe haven assets, as discussed, like the Japanese yen, Swiss franc, and sometimes even the US dollar. When a country's bond yields rise relative to others, it can attract foreign capital seeking the best return, which can strengthen its currency. For example, if US bond yields rise compared to European bond yields, the US dollar strengthens against the euro. It's important to check correlations before assuming a market is correlated. In uncertain times, we can often see these correlations fade. To summarise, we have learned about how to use equities to trade FX and intermarket correlations. Thanks for watching this video update. We hope you enjoyed learning through the Academy, and we'll speak to you soon.